To bring in Victoria Fernandez, Crossmark Global Investments Chief Market Strategist. We also have Mike Pugliese, Wells Fargo economist. Victoria, first to you, just your initial reaction to the fact that we did see the 50 basis point hike, but the dot plot rates rising to 5.1% this year, rates 4.1% in 2024. We're now looking at losses across all three of the major averages.
Yeah, so Seana, I think this is the key point. Two of the things that we were looking at from this meeting is to see where the median dot plot was going to be and whether the word ongoing was going to be left in the statement. So we look at the median 5.1, and remember, that's just the median, right? At the end of the year. That doesn't mean that's as high as they're going to go. It means at the end of the year they anticipate being there. So we could actually see Fed funds go quite a bit higher than that. Looks like that's a strong possibility based on what some of the other members were saying. So I don't think that we can say 5.1 is the ultimate level, but I think having ongoing left in the statement is extremely important. Ongoing usually means they'll continue to see rates not only at the next meeting, but beyond that. So that tells us we've got at least until March with continued rate hikes. We think those will probably be 25 basis points each, but basically all of this is coming in and the market is reading it as we are not done. The Fed is going to continue to raise rates. They're going to keep them higher for longer, like they've said. And even though the market tried to push back on some of that, I think Powell in his press conference is going to remain firm, and the market is reacting accordingly.
All right, Mike, your reaction to the decision and your projection for the terminal rate.
Yeah, I largely agree with what Victoria said. So going into this kind of meeting from the FOMC, what were we expecting? A median dot of 5 1/8, and then around 4% in 2024 and 3% in 2025. That's about what we got. We were expecting weaker economic projections, so lower GDP growth compared to what happened in September, right? Slightly higher unemployment. All of that comes in really roughly as expected. And the idea here really from us is that the Fed wants to see sustained lower inflation prints. It's not just about getting one or two in a row that miss to the downside, but seeing a sustained string of inflation runs that are much closer to 2%. So the recent data is welcome. I think directionally slower inflation argues for directionally slower monetary policy tightening, but there's a big difference between going down from 75 to 50 basis points per meeting and an outright pause, let alone cut. So this is very much in line with our kind of coming into the meeting forecast of, rates get to about 5 1/4 in the spring of next year, and they're left there really for the entirety of 2023. And it's not until 2024 when we finally get some monetary policy easing on the other side of a mild recession.
So, Victoria, on the heels of this ongoing left in this statement, likely higher for longer rates, is there any chance of a soft landing?
I mean, there's always a chance. You never want to say there's a 0% chance of something happening, but I think that chance is dwindling. I mean, you look, obviously we have growth slowing. We've seen that in the numbers. You have a 3-month to 10-year inversion of 83, 84 basis points. To me, that's huge. We don't have the positive real rates that we want to see that would help us have that soft landing. And look, I mean, we have earnings coming up. Earnings expectations are continuing to fall. And if you have prices coming down, but yet you have wages staying stagnant, you've got to have productivity in order for earnings to do well. And we're just not seeing productivity either. So wrapping all of these things up, along with a higher Fed funds rate, I think you're leading yourself into a recession sometime around the middle of next year. But I do think it'll be somewhat shallow because you've got a consumer that continues to spend. The Fed wants that demand to go down. Demand is not declining. It's just kind of being reallocated from goods into services. So I do anticipate we have a recession in the middle of next year, and then we'll bounce back probably towards the end of next year, ready to go into 2024.
Mike, your recession prediction, I do want to circle back to the consumer in a sec, but first, do you agree with that assessment? Middle of next year, a mild recession?
I do. And that's more or less our forecast as well. So a recession that starts in the middle of next year, maybe lasting a little bit longer so we don't have unemployment peaking until early 2024. But, financial markets very well may move in advance of that. Again, not particularly deep, an unemployment rate that peaks at 5.5%. So call it a couple percentage points above what we have now, but nothing like what we saw in 2020, 2008, 2009, when we had unemployment of 10% plus. I do still think there's a path to a soft landing. It's not our base case, but we often talk, I think, about the economy like it's binary, right? Either times are great and there's no recession, or times are terrible and we're in one. And I could envision a scenario where we got weak but positive growth next year, still above zero, maybe job growth that flatlines but doesn't meaningfully contract, and we get inflation, to 3% or a little below 3%. Again, that's not our base case, but that does strike me as a plausible outcome for a year from now.
Mike, the consumer has been very resilient, like Victoria was just saying. Are you expecting that scenario or that trend to begin to shift as the economy does potentially continue to weaken?
I do. Consumers are still in a pretty good place, right? They've seen rising debt levels, rising credit card usage, but off of low bases. Job growth continues to be pretty solid. There's been some near-term relief here as, we talk so much about core inflation, but headline inflation's really slowed a lot off the back of much lower energy prices. And we won't get the December CPI until on the other side of the holiday season, but it looks like that's going to be fairly weak as well, just based off where we're trending. So there's some near-term relief there on headline inflation and particularly energy prices. Job growth is still good. Wage gains have been solid. But as I do think as we get, deeper into next year, you'll see a little more consumer weakness as those excess savings are burned off, as credit utilization has gone up, and as job growth continues to slow. It started the year at 500,000 jobs a month, and we've seen it go from 500 to 400 to 300,000, now into the 200s. And I think that slowdown will continue into next year. And alongside, I think you'll see much slower consumer spending growth.
Victoria, a little closer look for you at the consumer. Can they continue to spend through this?
Well, so far they have, Dave. I mean, we look at what they're doing, and you can look at the consumer in two different categories. We have that higher end consumer, and they still have some of that money in savings, some of those stimulus payments that are there. So they've still got a little over $1 trillion that they can still spend. You look at a lower end consumer where perhaps they've gone through that savings a little bit. As was mentioned, credit card usage is going up. But when you have gasoline prices coming down, that's a much larger percentage of the income for that lower income spender. And so with those prices coming down, that gives them a little bit more to keep going. Obviously, here in the fourth quarter with the holidays, there's more spending than usual. People stretch themselves a little too far, probably. So I think we'll get good numbers this quarter. As we go into next year, then yes, I think the slowdown is there. Consumers will get a little more picky. Pricing power is going to be key for corporations to see who can keep those consumers and keep supporting those balance sheets. But I think we'll see a slowdown next year, but not completely going away.
Victoria, what does all this mean for investors? And I guess in particular, what do you think investors are going to want to hear or waiting to hear from Powell this afternoon?
Well, probably people want different things. I mean, financial conditions have been easing, right? We look at mortgage rates coming down, which supports housing, the dollar, which supports exports, dollar coming down, credit spreads coming in, which means CapEx is being supported. So I think they're going to be looking to see, is Powell going to push against a lot of this? If so, then I think that's going to be even more concern for that higher for longer thesis, that Powell is very adamant in pushing that Fed funds rate higher. So I think they're going to listen for that. How much is he pushing him back against easing financial conditions? Obviously, they want to see if there's any foreshadowing for the February and the March meeting. The market likes to look ahead and try to see what it can determine from parsing his words. So there'll be a lot of that as well. And I think one final thing they'll be looking at is what information is he going to give about quantitative tightening at this time? That's kind of been in the background for a while, but as they come to the end of hiking Fed funds rates, then quantitative tightening will be more in the forefront, and we'll want to get some more information on that.
Certainly will. Investors will be looking for any more detail that we can get, especially the tone that's coming from Fed Chair Jay Powell in just a few minutes from now. Victoria Fernandez, Mike Pugliese, thanks so much for joining us.